Hello to one and all. I'm Dan Leach, and I'm very excited to welcome in David Botset, Head of Innovation and Stewardship at Schwab Asset Management, and Chris Murphy, Head of ETF Specialists at T. Rowe Price. A lot of you in the audience know T. Rowe Price as a longtime leader in the realm of actively managed funds, while Schwab is one of the biggest names in index investing. We're thrilled to bring these two industry leaders together to help everyone watching understand the roles that active and passive strategies can play in a portfolio. We're going to dig into how active and passively managed ETFs can complement each other when one approach makes sense over the other, and how investors can combine them to achieve their objectives. Before we dive in, David and Chris would love you could take a moment to introduce yourselves and share a bit more about your role. David, let's start with you.
Thanks so much, Dan. It's great to be here today and looking forward to the discussion with Chris and yourself. As you said, my name is David Botset. I'm the Head of Innovation at Schwab Asset Management. At Schwab Asset Management, we are a $1.4 trillion asset manager, and we're thinking about innovation all the time. But one of the things at the heart of everything we do is also trying to make investing less complex for investors. They have a very straightforward way to implement the strategies within their portfolios to help them meet their objectives. I think that's best illustrated when you look at the Schwab ETF lineup. We have the fifth largest lineup of ETFs based on AUM in the industry today, and we've done that with just a little over 30 ETFs. So very successful in what we've delivered, and looking forward to the discussion today.
Thanks so much, David. Really happy to have you here as well. Chris, let's move over to you.
Sure. Thanks, Dan, and thank you, Benzinga community, for joining. Dan, as you mentioned, I'm Head of ETF Specialists here at T. Rowe Price. I've spent my entire career, believe it or not, in the ETF industry. So feel like I could share a wide range of perspectives and certainly talk about the massive growth that this industry has experienced over these 15 plus years that I've been involved. At T. Rowe Price, we offer 19 ETFs. We began our ETF journey back in 2020 and currently have about 15 billion in assets. So it's been a fun, quick, and exciting ride over the past couple of years, and we're just getting started and happy to discuss the growth of active ETFs, the use cases of active ETFs with you and the community here today.
Yeah, it's a heck of a time to be alive, that's for sure. Wonderful to have you both. And with that, I'm going to jump right in. David, let me start with you. How can investors effectively blend active and passive strategies within a single portfolio to optimize returns and manage their risk?
Dan, I'm glad you asked the question in that way about blending active and passive strategies, because it's something that we think about regularly, and we talk to investors at Schwab about it on a regular basis. I think there are three things that we think about when we talk about blending active and passive strategies. It's first and foremost starting with the investment objective and timeline of the investor. Secondly is cost. And third, what is risk tolerance? So let me touch on each of those components a little bit more. First, on the investment objective and timeline. I think this is the starting point of any conversation with an investor, is understanding what they're trying to achieve. Are they saving for retirement? Are they saving for a house down payment? Are they saving for child's education? That is very important in understanding what they're trying to achieve and how that blend may come together, as well as the timeline, because that timeline is very much tied to that investment objective. The second is cost. Cost is very important in helping you achieve your investment objectives over time. Some investors are willing to bear a bit more cost in trying to achieve those objectives, where others really want to squeeze every single dollar out of that cost that they can. So a very important consideration as well. And then thirdly is risk tolerance. We know passive strategies seek to track a benchmark. So when you open that statement every month or every quarter, when you get it and you're investing in a passive strategy, it's going to correspond very highly to the market benchmarks that you regularly see when you read the newspaper or you watch CNBC or Bloomberg TV. Other investors are seeking that opportunity for outperformance, and they have a little bit more tolerance for performance that differs from the benchmark. So that's another important consideration. And when you really start to blend all three of those components together, you start to get a picture of how you think about the weight between passive and active strategies within a portfolio.
Now, you laid that out there beautifully, David. And Chris, let's move over to you. How do you see it?
Listen, active management has always played a role with investors' portfolios and objectives. It's just what's different now is you can access active management in what has become the vehicle of choice via the ETF wrapper. And so, historically, if you're an investor that's primarily using ETFs, you've really only been given one option in terms of how to invest, and that's through either market cap weighted passive based ETFs or factor or multi-factor ETFs that all track an index. But up until the last couple of years now, you have opportunities to express certain active management capabilities via the ETF wrapper that you hadn't had in the past. And so we think active has always played a role, but now that it's more accessible via the ETF wrapper, investors need to start considering kind of how to your point, blend those strategies together, what the time horizon is, what is the manager's objective of that actively managed ETF, and how does that complement a market cap weighted or factor based ETF strategy that might you've been historically using. And so I think now you almost have to both re-underwrite your passive exposures, or in other words, re-scrutinize or look at what those passive exposures are giving you. And now what can you access via an actively managed ETF that can either complement or quite honestly replace that, given a specific asset class might be more suitable for active management. In other words, maybe have more propensity to outperform in certain asset classes with active management, given some inefficiencies of those asset classes. And so now that there's more options for investors to access active management in the vehicle of choice, you're starting to see a bit of a resurgence of active management, a bit of a louder drumbeat of the benefits of active, how it can complement passive, but also how it can replace passive in certain pockets of the market. And those are the conversations we're having in and every day with investors.
No, I love it. And as you said, blending those two strategies, it really is a fascinating thing. Chris, let me stay with you and ask you, what asset classes or market conditions do you think tend to favor active strategies over passive ones and vice versa?
Yeah, it's a good segue from that prior question, Dan, because definitely zoning in on specific asset classes, like I mentioned, that have historically lent itself to active managers would be the first place to look naturally. And in one of those pockets, we think is in the small and mid cap U.S. equity markets. This is a market cap that has, if you just look at the Russell 1000, 2000, for example, has really deteriorated in its quality. In other words, over 45% or so of the index is in non-earners. So companies that aren't generating any earnings or revenue. And so that one in and of itself, I think is a bit of a red flag for passive investing in that asset class. Two, analyst coverage. So how much attention essentially are small mid cap stocks getting from Wall Street? Analyst coverage has significantly declined in the small mid cap space. So more opportunity to exploit inefficiencies from a bottom up fundamental research platform like we have at T. Rowe Price to find those next winners when the street aren't covering them to the extent they were several years ago. And then finally, the ability to navigate different subsectors and industries within the small mid cap space where we think active management is critical. Think of biotechnology, think of software and services, certain asset classes or sub industries where you really need to understand the trajectory of a specific company, its goals, its management. Where active managers that are doing the boots on the ground, fundamental research, meeting with executives at those companies to understand the goals and capital allocation strategies that they're employing really gives a leg up for active management, specifically in the small mid cap space. Again, that's not trafficked heavily as much, and where the index just isn't giving you maybe what you want from the exposure perspective, and the ability to particularly outperform and find those new crop of winners that the index is going to own, but not maybe own to the extent that it should. So that would be one asset class that I would think of as really ripe for active management. Now in the ETF wrapper at lower fee and more tax efficiency, I think is a really compelling opportunity. Secondly, on the fixed income side, high yield is another asset class that we think has really been underserved from an active management perspective in the ETF wrapper. And clearly that's an asset class in a category where we think credit research, understanding the credits that you own or not own in particular, is critical in these types of market environments to not necessarily drive particular outperformance, but really effectively navigate kind of what could happen in a default scenario or any type of breaks in the credit market and not owning those companies that might be more susceptible to challenging environments. That's where active management really shines, specifically in the high yield credit space. And I think that's an area of the market that, again, has been underserved and where active management tends to work. And now being available in the ETF wrapper, again, is a really compelling asset class and strategy that investors should consider who want to venture into the high yield credit markets within U.S. equity or within the U.S. High yield space.
Yeah, it's such an important information. That's why days like today are so important. Why I'm so lucky to have both of you. And David, let me go over to you and ask you the same question about, when you look at the asset classes or market conditions, they tend to favor the active strategy over passive ones and vice versa. How do you see it?
I think we at Schwab Asset Management see it much the same way as Chris just talked about. The propensity for outperformance in different market segments, but I may frame it slightly different way. Really thinking about the market efficiencies component is playing a role in strategic allocation decisions. So Chris mentioned that the opportunity for potential small cap outperformance. The same could be said looking at domestic versus international, where domestic equities are covered much more from a global perspective by analysts than international or emerging market equities. So you see many times in the Schwab Asset Management strategic asset allocation models, we will tend to use more active strategies in international and emerging market equities in, say, our Schwab target date funds or in the Schwab model portfolios than we will on the domestic equity side. There's also that market efficiencies in the ability to index certain segments of the market. Chris mentioned high yield. I would go to the ultra short duration space. It's a key critical component to many investors' portfolios, but quite frankly, it is a very challenging part of the market to develop an index that is representative of the exposure that you would get there. So we've found that that is a segment that can often be tackled using actively managed strategies versus index strategies. That kind of gets to that strategic element. Then there's also a bit of a tactical and timing element. You look at different periods of time in the market where the dispersion of returns could be very narrow or broad benchmarks are really driven higher by a limited number of names. You look at 2024, where a limited number of names were driving many of the broad benchmarks. It made it really tough for active managers to outperform. So that's kind of a tactical component of consideration of saying, in this market environment, is there a greater dispersion of returns? To the extent there is, that likely opens up more opportunities for active managers to outperform, which may weigh on that balance between using passive and active in your portfolio.
It's beautifully explained. And David, I want to go to you first here. A lot of people know, passive investing is often touted for its low cost, but does that always translate to better performance over the long term? And also, how does active management justify its fee structure today?
Yeah, so I think all else being equal, low cost will help drive greater returns. If we think about it just at the highest level, when you look at many passive strategies, especially domestic strategies, that they may charge 2, 3, or 4 basis points, much like many of the Schwab index ETFs charge. And you compare that to a competing active strategy that may charge 40, 50, 60 basis points. You're already setting up a threshold of outperformance that is necessary for the active manager to deliver just to be equal with the passive strategy. So that may be 40, 50, 60 basis points of outperformance to deliver on an annual basis just to be equal. It's a pretty high threshold, a pretty high bar for an active manager to deliver. So again, it gets back to all else being equal, yes. But there are those opportunities, especially in those less efficient market segments, where active managers have a greater opportunity to outperform. And on a cost to cost basis, it can make sense to look at a higher price active strategy when they've got a greater opportunity to outperform.
Absolutely. And Chris, how do you see that from the active perspective in your view?
Yeah, I would agree with David that one of the key elements to when you look at active managers being able to outperform, the first thing you can kind of speak to is the cost of that product in that strategy. But you also need to consider kind of what you're getting for your, cost, right? Are you getting a manager that is more of a closet indexer, so to speak, that isn't really truly adding value beyond the benchmark or making, you know, high conviction calls on specific stocks or sectors to generate a performance delta over that fee that is substantial enough to outweigh that extra 40 basis points. So, understanding kind of what the process, what the strategy is, and are you getting what you're paying for, we think is critical. At T. Rowe Price, we pride ourselves in being very competitively priced across all of our ETFs. And in areas where, we think we can add significant outperformance above that fee barrier that David mentioned. And so, I think fees are important, but you also need to understand what am I getting for my fees? At T. Rowe Price, you're getting a global research platform with hundreds of analysts that are tasked at knowing the companies that we're recommending and buying better than their management companies. So we think it's critical that you're getting what you're paying for, and at your price, we think you are, being more than compensated for the level of due diligence, the level of scrutiny that we're putting on every individual stock that we own in our portfolios, and being stewards of that capital in a very efficient way, in delivering performance that can be above that fee gap that David mentioned. One thing I would say too is that fees are important, but they're not necessarily something that I think need to be as scrutinized as maybe they have been in the past. Given that you can deliver outperformance that would significantly outweigh the benefit of going into a lower fee kind of commoditized beta exposure in that specific asset class, where, there's an opportunity cost, I think, associated for investors that they need to consider as well. And now that have active strategies in all areas of the market across all different pockets of investors' portfolios, there is opportunity for alpha to be had, even if it comes out of extra 40 basis points. That 40 basis points we think can be totally outweighed over a long period of time if active management is done appropriately and effectively. And we think that's what we deliver here at T. Rowe Price. So fees are important, but it shouldn't stop you from at least trying to discover some managers that can deliver on those fees.
For sure, man. We all know clients love value, and Chris, let me stay with you. Clients also love wins. How do you measure success when integrating both approaches? Is it alpha generation, like you mentioned, cost efficiency? Is it risk adjusted returns or something else?
Yeah, that's kind of a loaded question, Dan, because it's really dependent on what your objectives are, right? If you're putting together a portfolio on behalf of other clients or for yourself, you want to make sure that it's suitable for you and your objectives. And so, active management can really play a critical role in a variety of ways, right? Alpha generation is purely, the primary objective is to generate alpha above its benchmark or outperformance above its benchmark. Downside protection is another element that, as you can start to see more active ETFs come to market using derivatives, so whether that's futures or options to deliver certain outcomes, whether that's option premium income or downside protection. Active ETFs can play a critical role in protecting and preserving principal, in helping manage sequence of return risks for retirees, manage those drawdowns or tail risk events. And so it really depends on your objective, really depends on what your current portfolio looks like in terms of how to assess the benefits of active strategies in your current lineup of portfolio of ETFs in your portfolio. And it's really assessing kind of what you're paying for, but also what you're getting. And so we think it's a variety of inputs to assess what's successful with adding an active ETF into your portfolio. Um, but all that means is some extra homework for you and due diligence for you in terms of how that fits, and thinking about asset allocation less around diversification of asset classes, but diversification of strategies that you're blending together, and how diversification across an active fundamental, active equity ETF compare with a market cap, compare with a single factor ETF, and provide you maybe smoother returns over time rather than just saying, let's allocate to the large, mid, and small and international. It's a diversification of investment strategies that we think is really a critical piece of asset allocation that might be, underutilized by investors today.
Well, Chris, you answered the loaded question beautifully. Let's go over to David and see what he thinks when it comes to how you measure success in integrating both approaches.
I agree much with what Chris said there. When you really think about it through the lens of the investor, are we helping investors achieve their desired outcome? And even if that desired outcome is something like retirement, that objective and the interim stages along the way change over the course of somebody's life. If I'm a young investor coming in and I'm saving for retirement, I've got a long time horizon, I may be able to withstand more volatility in my portfolio, and I may be able to sustain the swings a lot more than as I'm getting closer to retirement. And it's less about the significant upside opportunity, and it's more about the downside protection that I'm trying to preserve in my portfolio. So, getting back to what Chris said, it's not necessarily just about alpha or costs or risk adjusted returns. It's about understanding the desired outcome for that investor and helping to construct a portfolio that helps them meet that outcome, and also the dynamic change of those outcomes over the life of that objective that they're saving for. Same could be said if you're saving for a child's college education. That dynamic of what you're able to stomach and your expectations returns are very different when your child is 1 year old versus a child that may be 17, 18, or in the midst of college, where you can't stomach that downside nearly as significantly. So that really can inform that passive to active allocation and the types of strategies you're using. I think Chris said it very, very well. You think about not only that balance, but do you have things that are more on the downside protection, less aggressive? You maybe use a more of a defensive strategy, whether that be active or passive. You think about the fixed income exposure. Do you go from an intermediate exposure to short to ultra short over the duration of that portfolio of what you're trying to achieve? All of that will balance those returns and help you achieve that objective. And throughout that, you're likely balancing active and passive in very different ways.
Back to back, beautiful answers to a loaded question. I got the top level guys here today. Chris, let me go back to you. With the rise of thematic and factor based ETFs, do you think we're seeing a blurring of the lines between active and passive? How do you define those boundaries today?
Yeah, so active ETFs are, entering a tough arena, right? The ETF market is dominated, and it's been synonymous with passive, right, for the past 30 plus years. And to some extent, it still is. But as we know, right, active ETFs are gaining a lot of share, month over month, quarter over quarter. Their flows are representing 20, 30, 40% of the overall industry flows, whereas they only represent 8% of the overall ETF market. And so, for a lot of ways, passive, factor based, rules based ETFs are still the strategy of choice, given the size of that pool of assets in those strategies. But active ETFs are starting to kind of wedge themselves in to the factor based, rules based strategies in the ETF wrapper that exists. There's a quote I really like from Harry Day, who was a Royal Air Force pilot during World War II, that says, "Rules are for the obedience of fools, but for the guidance of wise men." And I think that's a really interesting quote when putting that into perspective of investing, and particularly passive versus active, right? A lot of these indices that we talk about that uh, track these ETFs are rules based, right? Maybe they're trying to isolate quality stocks or minimum volatility stocks in the US equity markets and have a specific set of rules that guide the index construction. uh, we all know rules work and rules can isolate those exposures, but not necessarily be the best way of accessing that specific category or investment objective. And so active management is where we can take some ideas around what those rules give you, uh, but also provide some additional levers and thoughtfulness to approaching that investment style. And so you can still get access, for example, to high quality dividend growth stocks with an actively managed strategy, but not be indentured to the rules of a passive dividend growth, for example, ETF, right? And we think that that freedom of being able to go outside the rules and to understand kind of why a specific company is increasing its dividend at a specific rate, or why it cut their dividend and what that means to the future dividend payments of that company, and whether or not we think this is a good buying opportunity is really important, rather than being, again, indentured to the rules where we might have to remove that stock or not be able to own that stock in an active, in a passive rules-based dividend portfolio, whereas otherwise we could own that in an active dividend growth portfolio. So I think it's blurring the lines, but it's also allowing investors to still get access to a specific investment objective or strategy like dividend growers or quality, but we think in a more thoughtful way through the access of active management.
I love that you're bringing World War II quotes, so I'll give you a Churchill one. The price of greatness is responsibility. There you go. David, how do you see things?
From our vantage point at Schwab Asset Management, I don't think the lines are blurring. I think they've been blurred for many years. I go back and look back. It's been now, I think, a decade plus, just as an example, that Morningstar first introduced what they call the strategic beta classification system, where they really sought to deliver a framework that allowed investors to assess traditional cap-weighted index strategies relative to more factor-based index strategies. I think it may be just there's a question about blurring because there's been more proliferation of those types of strategies, whether they're thematic, they're factor-based, rules-based index strategies, or factor-based active strategies. The proliferation is just likely increase the evidence in the marketplace that those lines have been blurred for quite some time. I think the key component to think about here is less about whether the lines are blurred. It's more about how you bring those strategies together to help you achieve your investment outcomes. Chris mentioned factor exposures earlier and making sure they're balanced. I think it's important for folks viewing this session to really kind of think about what exposures do traditional cap weighted indexes provide. Many times and over the course of time, cap weighted index strategies tend to provide greater exposure to factors like growth and momentum. That's not good or bad, it's just the reality of the way they are constructed and a weighting based on market cap. As the market cap gets bigger, the weighting increases. That tends to be a factor weighting to growth and momentum. And that can result in wide swings of performance over time if growth and momentum factors go out of favor. So we've been talking to investors for a long time about thinking through those factor exposures. It's one of the reasons that over a decade ago we launched the Schwab Fundamental Index products. Those strategies are based upon research affiliates' fundamental indexes. The methodology of those indexes tend to provide more exposure to smaller names and value-oriented exposures. So supporting a notion that Chris had earlier about bringing together different factors in the case of market cap with growth and momentum alongside value factors, that can provide, it has the opportunity to provide rather, a smoother ride over time for investors and over a full market cycle, the ability to deliver improved performance. The same can be said as you bring in active managers into that strategy. Understand the exposures you're getting and how they balance out the exposures you may get in your passive strategies really can help guide the balance that you bring together in your overall portfolio.
It's perfectly said. And David, let me stay with you and let's talk about the role tactical allocation decisions play in a mixed strategy portfolio and who should be making those calls. Is it advisors, portfolio managers, or these days algorithms?
Yeah. Well, I think first off, we start with the notion that time in the market tends to be more important than timing the market. I think that you've heard, and many investors have heard that time and time again, and I think it rings true. But there is an important component of thinking about your allocation decisions. And many times I think about starting with not tactical allocations per se, but thinking more around making sure you're rebalancing your portfolio back to your strategic weights. That is, in effect, a way to think about tactical allocations. Why does that become so important? You think about a traditional portfolio, and I'll keep it really, really simple and say a 60% equity portfolio, 40% fixed income. If over time, as has historically been the case, if equity markets outperform fixed income, that original 60-40 portfolio is going to appreciate in value faster than the fixed income. And you may get to a point in the future where that balance is now 70% equity, 30% fixed income. By the very nature of reducing your equity exposure back to 60% and reallocating your 40% to fixed income, it's a natural way to reallocate, because what are you doing? You're selling your winners and you're buying your losers, so to speak. Right? That's what you want to do when you tactically allocate. You want to overweight to your winners and underweight to your losers. By naturally doing that over time, it's a way to think about a tactical allocation, but just bringing it back to those strategic weights. Beyond doing that type of rebalancing, I think it gets back to a notion we talked about earlier and thinking about what is the propensity in this market environment for different strategies to outperform. Here recently, we've seen international markets outperform. And if you've had a view into that in advance, a slight overweight to international would have certainly benefited your portfolio, but making sure you're doing that within a range you've kind of pre-established, and you're basing that upon metrics you understand in the marketplace and have a high degree of certainty that it will drive that outperformance over time.
It's fantastic. Explain, Chris. We go over to you, and how do you see it?
ETFs really lend themselves nicely to tactical asset allocation, right? And it's kind of one of the primary use cases early days of ETFs is tactical asset allocation through sectors and industries, and even broader asset classes. And so I think that ETF as a tool is really nicely designed for tactical asset allocation. What drives that tactical asset allocation, I think, is up for debate in terms of what strategy works best, right? There's certain technical indicators that many look at in terms of driving their tactical asset allocation. There are economic factors that drive tactical asset allocation across sectors and factors in terms of when they work in certain economic environments. And then there's certainly just purely kind of algorithmic driven, momentum driven strategies that can drive tactical asset allocation. I don't think there's one perfect silver bullet as an input for what you should be basing your tactical asset allocation on. But I do think ETFs are a great tool to implement tactical asset allocation. I do think tactical asset allocation could serve a really meaningful purpose in a portfolio, almost as a sleeve, right? Like we talked about earlier, as David just mentioned, diversification strategies, right? How can a strategic asset allocation 60-40 portfolio be enhanced or complemented with a maybe tactical sector asset allocation strategy or international tactical asset allocation strategy as a bolt-on to that strategic diversified portfolio? I think it's certainly it deserves a purpose and an opportunity to be a part of any client's portfolio, but there's a lot more work that needs to be involved, right? You need to be able to build out a framework for how that tactical asset allocation is built upon and then implement it appropriately with the right tools. I think now that you start to see more actively managed ETFs in the sector, in industry categories, where that's typically a place where tactical asset allocation is trafficked heavily in, maybe there's better alternatives than just owning the pure GICS-weighted sector ETFs that you've been using. Maybe an active manager in a tactical asset allocation portfolio can provide some additional alpha on top of just a pure market cap weighted sector strategy, for example. And so I think there's just many ways to do it, but it goes back to diversification of strategies, right? Active equity, tactical asset allocation, passive equity, passive fixed income, active fixed income. Diversifying out your tools and strategies and disciplines of those strategies in a portfolio, we think over time will serve clients really well. And tactical asset allocation is certainly a piece of that puzzle that you could add.
I definitely could have asked for two better guests the way you guys have laid things out here today. It's been phenomenal so far. And Chris, let me start with you here. As ETFs continue to evolve, do you foresee active strategies gaining more ground within the ETF structure? Why or why not?
Well, if you go back to data and just look at the numbers, it's certainly indicating that way, right? If you look at the number of products being brought to market that are actively managed, as I mentioned, the percentage of flows that are going into actively managed ETFs relative to their market share, it's all pointing up and to the right in terms of the growth trajectory of the active ETF market. The number of issuers, right, have grown significantly. Traditional actively managed mutual fund issuers like T. Rowe Price have entered the ETF market and others. And so I think that active ETFs are certainly here to stay and will continue to capture market share across both the ETF market and the broader 40 Act fund mutual fund market as investors look to find lower cost, more tax efficient ways to still maintain active management in different pockets of their clients' portfolio. So I think it's here to stay. I think what's really interesting to see is the diversification of the active ETF market in terms of categories that are leading the flows in AUM. So when you look at the top 5 categories within the active ETF market, it's ultra short-term fixed income, large cap core, derivative income, hedged equity. So a very wide variety of strategies and asset classes that are finding money coming their way in the active ETF market, which I think is a really healthy sign. You think about the growth of a particular category. It's not just in a couple of traditional sectors like large cap growth or large cap core. It's in a variety of strategies, which I think is only good for the investor, right? There's more options, more choices, more ways to build portfolios more effectively for you and your clients and build better outcomes.
Absolutely. David, how do you see it?
Much the same. I think there's a long runway for growth for active strategies in the ETF wrapper. And I would point to a couple of things behind that. Annually now for over a decade, Schwab has been conducting the ETF investor study. And over that period of time, it's allowed us to really better understand preferences of investors. And the one thing that has held true over time is that investors increasingly prefer the ETF wrapper as a way to gain investment exposure over mutual funds. And we've seen that with a huge migration of assets moving from mutual funds to ETFs over the past decade plus. The other dynamic that you see within that study is that younger investors, those that are just really starting to build wealth, have a higher preference for ETFs over mutual funds than older investors. So I think that continues to support that as that younger generation continues to build wealth, their selection of choice in terms of product wrapper will be an ETF over a mutual fund that will continue to drive asset growth within active strategies. Do we believe that active ETFs are going to overtake passive ETFs in AUM? I think the likelihood of that is quite small, but I would expect that active ETFs will continue to grow. Reinforcing a point that Chris made about some of the top asset capturing active categories in ETFs. Large core was one of the few in that list that is also one of the largest active mutual fund categories. So I think there are a lot of assets that still set in active mutual funds that will eventually migrate over to active ETF strategies and continue to drive growth in those products over time. So we continue to see that growth of the active ETF space and ETFs in general.
Yeah, it really has been an incredible sea change. That is for sure. Like I say, it's a great time to be alive. Let's go back to Chris. Technological or data advancements are helping to improve the synergy between active and passive strategies.
Yeah, so one of the beautiful pieces in hallmarks of an ETF is the predictability, right? And I think that's mainly driven the fact that ETFs have primarily been rules-based or passive and given advisors, investors access to predictable outcomes, meaning indices that are built upon whether it's financial metrics like quality or value, or simply just market cap weighted. And you can regress those factors back in time to understand kind of how those would act and how they would perform in different market environments. And what I think technological advancements are helping active managers with are harnessing some of those predictable factors and kind of benefits that predictability provides to investors, but also overlaying fundamental active management, which we think again is critical in terms of long-term success for investors' portfolios. So being able to provide those quantitative metrics, overlay fundamental analysis, and really distill that portfolio into a basket of stocks within a particular category that screen well on both the quantitative side for quality or value or growth, as well as input our fundamental research into those specific names to identify really what we think would be the best basket of that type of exposure, is really where I think technology is helping active managers kind of blur the lines between predictability and pure quant with fundamentals. So quantamental is what we maybe might call it in terms of being able to give investors that predictable outcome, but with the benefits of long-term fundamental active management on top of it, in the ETF wrapper, which is very suitable for that type of investment approach, is I think a really big opportunity for the ETF market and for a firm like T. Rowe Price. We continue to look at that as ways to bring product and marketing strategies to market to offer to investors.
Saying stuff. Well, listen, that's all the time we have. I want to thank David and Chris for all their fantastic and great insights. This conversation really does underscore the fact that ETF investors have an incredible breadth of choices before them today. Having a clear understanding of passive and active ETFs and the unique benefits they both bring to the table is table stakes for building a very smart portfolio. You can learn more about Schwab and T. Rowe Price's ETF offerings and thought leadership by visiting troweprice.com/active ETFs and schwabassetmanagement.com. I'm Dan Leach, and once again, we want to thank all of you so much for joining us today.